All right, so I hope everyone is doing fine. Uh, we are going to look at this question for Tonaptu. So, as we said, we have materials and we have questions that have been attempted. So, I'm going to be trying to attempt those questions that are bringing something which is new, new perspective, but also questions that I've not attempted. So that at least when we combine between those questions that I've attempted and these ones, you get you get the full picture. So then when you find yourself on one of the questions that we have already done and you really wanted to see it maybe reattempted in, or you have some questions that you still have on it, then you can also still let me know and then we arrange to do that. So for now, let us attempt this question. Tonpantau. So of course, when you go to the, as you are doing these questions, you normally have to first go to the requirements. And here they are asking us to evaluate financial acceptability of a project proposed investments. So that is one. Then also discuss with reference to the proposed investment, how your options build on traditional net present value when evaluating investment decisions, and then the problems with incorporating and evaluating real options. So, and then they want you to look at the Black Scholes model as you're answering. So, and then of course, what you're going to find is that there is going to be, of course, professional marks that you're going to get. So, and those professional marks that you're going to get are going to be based on whether you have demonstrated the analysis skills, in this case, evaluation, skepticism, and commercial acumen when you are answering. So, and how do they tell that you have done so? This is a skill that you learn as you go on, but basically there is a technical article which I am sure you should have already read, which explains these different skills that you need to know. Like analysis and evaluation is going to be in how you compute and also discuss the figures that you have computed. Skepticism is going to be how you show a questioning mind so that you question the facts that are given to you and assumptions that have been made. Then commercial acumen means you understand the business language. In this case, we are referring to the fact that you can actually be able to determine what the question is talking about regarding the business language that is being used. So things like mergers and acquisitions, things like investment opportunities, which usually also comes in when you are discussing. So those are the 5 marks that you get for this question. So having looked at the question, then we can now go and look at the scenario. And this scenario, they are saying that they have given you the proposed investment and then also the detailed investment that you're going to actually be encountering. So now when you start with the proposed investment, so they are saying that this company, Tonpantau, is a publishing company. Right now, it publishes mathematics and business studies texts and also online study materials for schools. So now they want to enter new markets in those areas. So when you are looking at businesses, businesses can usually go either way. They have situations whereby business decides to invest in a new market, but for the same industry. Then they can also decide to invest in a new product, or they can decide to integrate vertically, whereby they acquire other companies in the value chain, which is something that you should know when you are referring to mergers and acquisitions and all that. But basically, Now, what you need to understand in this case is that in this case, they are telling us that they are trying to get into new markets in these study subject areas. So they want to produce materials for mathematics degree courses. So they have been doing it for schools. So they are considering looking at degree courses, but then they want also to produce it for other university courses and professional qualifications. So now, directors feel that the decision to invest being made in phases and possibly of not pursuing the investment further if sales of the mathematics materials are disappointing are significant. Now, this is where the real options come in. So, ideally, in normal cases, when you have a situation, you either invest or not. So, it means that when you invest, then if things go wrong, you're going to lose all your money. But then, if you actually don't invest, then you lose all your money. So there is not anything in between there that you can maybe invest and then have prospects for selling that business in future. They will to be that you either invest everything at once or not. But you see, these guys want to invest in phases. So there is a potential because they start by doing university degree courses for mathematics. And so if this is successful, that's when they can now go on and look at other courses and professional qualifications. So which is a good thing, but they are not sure how to incorporate these factors in the investment appraisal. So, and that's where real options come in, as we shall see how we incorporate that. Directors also uncertain about whether its closest competitors have any plans to enter these new markets. So they don't know whether the competition also may try to do what they are doing. So these are some of the things that when you need to look at here. Now, that is the information that we have here. So, and they don't know if we are successful, if the competition also will join in. So that is the investment that we are looking at. So now, of course, that is qualitative because we have just sentiments and all, but then we need to put it in terms of figures. And when it comes to the figures, they are telling us that the board has a 4-year time horizon for consideration of the investment based on the current plans for the producing the new material. Now, the planned capital expenditure is as follows. So they will incur 20 million immediately, another 20 million in year 1, another 20 million in year 2, 12 million in year 2 rather. So this is the expenditure that they want to have as capital expenditure. But then they also have working capital at the start of each year. So at the start of year 1, 3 million. At the start of year 2, 3.45. And at the start of year 3, 4 million. At the start of year 4, 3.8. And they expect to fully recover that money at the end of year 4. Now, what we are looking at here, these questions for investment appraisal, if you've gone through the materials, or even if you've not gone through the materials, you go through them. But basically, when you are looking at this question, there are things that keep on happening, recurring items. And the recurring items that you need to understand are going to be, of course, the capital investment. Then you need to know whether there is working capital, and working capital, whether it is recovered or not. Then you need to know tax implications and also tax allowable depreciation. Then you may look at inflation. And then it comes to the cost of capital. You may find yourself having to calculate it. So you may need to do work, or you may need to do capital asset pricing model and other methods under here. but at least in some way or some shape, you're going to find yourself dealing with these issues. Now, so in this case, they have told us the capital investment, they have told us the working capital, and then now they are saying the forecast pre-tax profits for the investment are given below, and they have been given to us after removing depreciation, which is the same as the accounting depreciation. Now, in finance, these are usually not the same, okay? Because, for example, URA will give you a different rate to use compared to what rate you are going to receive maybe from your finance manager or your accountant. Because your accountant is using a company policy to depreciate something maybe over 5 years, whereas the revenue authority has their own depreciation that they are following, which tries to have, in this case, for us, different classes for different assets and their uses. So, but here they've told us that these are the same, so that's okay. So they have told us that those are the same, and the figures they have given to us are after deducting those those figures. So, and these are the figures that have been given to us. So this is the depreciation. They have shown it to us, which is a good thing. And these are the pre-tax profits. Okay. Now, tax is 20%, and in the year in which the first profits are made. So when it comes to tax, you need to know what rate it is and when is it paid. So here it is paid in the year in which the profits are made. So having known that, then there is another company called Bodfari, and this company, they are saying, produces mathematics and business studies materials for university professional exam courses. So it has a debt equity ratio of 2575, and its equity beta is 1.6. So they're saying that the current risk-free rate is 4.25. They have told us also that the equity ratio of Tonpantau is 40/60. So it means that this 40/60 is the gearing that we have. Then they have told us that the current risk-free rate is 4.25. So now the market premium is 5.5. Then for the purpose of estimating the cost of capital, you're saying that we can assume that the beta of debt is 0. So all this is information that we normally are going to find ourselves using to find the cost of capital that we are going to use for our calculation. So now, having known all that, then we can go on and look at the financing of this company of ours. It has debt, which is 6% bond, nominal value 100, premium of 4%, redemption in 4 years' time. So the coupon on the bond is payable on an annual basis. And this is the spot which is given to us. So 1 year, 4%, 2 years, so on. This is called the spot rate curve. So we have this information, and then we know what our question is asking us to do. So we are going to start with that evaluation. Basically, try to set up and see how we should be attempting such a question and other questions that ask you for investment for acceptability using net present value. And so Remember, we are going to be working in a spreadsheet, so although it's not this very one, but this can emulate exactly what you are going to find there. So you need to set up your cash flows properly. So this is part A. So financial stability. Okay. So now we can choose to work in millions, but all the figures that have been given to us are in thousands. So usually it's better to work in the accuracy that is given to you. If not, you can choose your own accuracy, but don't over round of things. And also don't work in dollars usually, because then if you have millions, then of course when we are doing it with Excel, it may not have so much of a difference, but it helps to have some kind of rounding. So we are going to work in thousands. So what you have is the years 0, 1, 2, 3, 4. Now the project is for 4 years, and tax is payable in the same year, so we shall need 4 years for our project in terms of the duration. So now, ideally, let me tell you how this cash flow is arranged. You would have revenue, then you would have costs. Okay, you'd have costs, and those costs can be variable costs, fixed costs, but they have to be costs that are relevant. And when they say relevant, it means that they have a direct impact on how you end up calculating the like on a decision, like they have a direct impact on the decision, the cash flows. So they have to be cash flows. So sometimes you find that you do taxable depreciation here, then you get taxable profits. And these taxable profits are so-called pre-tax profits. Then after that, you less the tax at a given percentage. Then you add back the depreciation because it's not a cash flow. Okay, from there, then you bring working capital. If you have any, then you bring the investment, then you bring the scrap, then you get the total cash flows. Then from here, you get a discount factor at a given percentage. Then you get a present value and finally net present value. So this is a typical workflow of how this is going to be. Now, you have to just look at what is given to you, see if you have revenues and you have costs. But when I look at what we have been given, they have given us the expenditure, then working capital, then they're giving us the pre-tax profits. So it means that they haven't given us all of this. Okay, these first two lines have not been given to us. They've given us the pre-tax profits. So which means that you can put the pre-tax profits right away. So 8,700, 11,600, 15,200, and 15,500. And they have said that these ones are after, okay? And they have even underlined it. They are after the deduction of the taxable depreciation. Okay, so they are just right here. So it's very important to know what you are working with, because then you know which figures you have been given. And the thing is, these lines here, we don't need them in this case because they have given us the figure that you would get after applying the steps up. So when you are doing this question and you find that's what you have, don't put the lines there. Just start from the pre-tax profits. At this point, you tax, okay? And the tax rate is 20%. And in the same year, so 20% of the tax of the figure that you have. So you get yourself your tax. And then, as I said, we have to add back the depreciation. So 2,600, 5,200, 6,700, and 6,700. So that's how we add back the depreciation. Then bring working capital. So working capital, they said at the start of each year, which means that if we are looking at year one, we are saying start of year one, which means that that is the end of year. That's the end of year 0. Now, working capital, what they have given us is what we are going to need at the start of each year. So we need a small working on this one. So we are going to call this one working 1. So we can come here and put our workings. Okay, you don't have to put them on the same line. You can really put them up here. Okay, just have to organize yourself very well. Then the first working is working capital. So now we're going to need the years. So we can copy these ones. Now remember, we are going to also work in thousands. So that whatever we get, we can just transpose it the other side. So just let me remove the coloring from this. Okay. So what is the working capital needed? It is 3,000 over the 3 million, then 3,450, 4 million, and 3.8. Now, what you notice that I have put them at the end of year 0, which is start of year 1. Then end of year 1, which is start of year 2, end of year 2, and end of year 3. So because the conversion that we take is that when I write it, when I put my years here, everything I'm putting under it is at the end of the year. So that is the conversion that we use. Now, if I need 3 million at the end of year 0, and I need 3.45 at the end of year 1, I don't always get the entire amount. The way it works is that I get incremental. So what I need is the change. Of course, for the start, I will need the entire 3 million, but then I will need the difference between 3.45 and 3 million. Okay, so I will need 450. And now, if I have 3.45 and I need 4 million, I'll need another 550. And then if I now need 3.8 and I have 4 million, I will need to release some money, 200,000, because I need less than what I have. So I release some. Then at the end of the 4 years, all of the money of the working capital should be fully released. So it means that I can do a minus sum of all these figures. So that means that at the end of the day, the end of the 4 years, all the 3.8 million that I had has to be released. So that's what I need to bring here. So at the beginning of, at the end of year 0, which is beginning of year 1, I will need 3.3 million. Okay, 3 million. Then you drag and you bring order. And this is supposed to be a minus. Okay, because that's a cash, it's a cash outflow. Okay, this is a cash outflow. It's a cash outflow, cash outflow, cash outflow, cash inflow, cash inflow. Okay, please, if you are not following, let me know. But if you're following, that's okay. We can proceed. When you have questions,
Maybe
yeah,
sorry, I had a question.
yes.
In what wording would they use when they want us to, like, for example, I've seen situations whereby we start with year one. Is it that they won't say at the beginning of the year? Which wording would they use in the question?
Where they want us to start with year 1. Sorry, I lost you a bit. Can you hear me now?
Yes, I can hear you.
Okay.
I was asking,
Mm,
like, are there situations whereby the working capital, the changes,
yeah.
or the working capital would begin in year one rather than starting in year zero, where we start
Oh,
our computations of changes in year one?
okay. Usually with working capital, they will tell you that there will be immediate working capital needed at the beginning of the project. Because the way working capital is, working capital is supposed to finance the current assets less current liabilities. That difference there. So in most cases, or at almost always, we start from the beginning of the project, which is year 0. So the question will tell you that the working capital will be at the beginning of the project, and then they can tell you that an other additional working capital will be needed for every dollar increase in revenue. We shall see a question like that, or if you go through my questions that I've shared with you, you will see several questions that have been attempted, which mention that. But if you find one where they want you to start from year 1, they will tell you that at the end of year 1, okay, if that's what they wanted to do. But most cases, almost always, they want you to start from year 0 because you start with the working capital and then you either increase or decrease. Is that clear?
Yes, thank you.
Yeah, welcome. So we have reached working capital, and then what happens next is to bring investment, and the investment is going to be phased. So at the beginning, 20 million, another 20 million, and another 12 million. So those are the investments. And then scrap. Okay. Now, for us to know whether it's going to be scrap, the question may tell you. Okay. The question might tell you. The question tells you that the project will be sold after the 4 years for this much, or they will recover this much. And in this question, we have not seen anything that says that there is going to be any scrap. But another thing that you can try to see when you're calculating depreciation, okay, although here they did it for us, sometimes they may need to tell you what is the scrap value so that you can see if there is a balancing allowance or balancing adjustment. But here we don't see it. But if you get 6.7 and 6.7, that gives you what? 13.4 plus another 5.2, that is 18.6, plus another 2.6, that is 21.2. Okay? Have I added very well? I think I've added very, yeah. So 21.2. And yet, the expenditure that we have here is the 52 million. So depreciation, they are depreciating 21.2. And they're saying it's the same as the one which is given to you as the accounting depreciation. So anyway, here we cannot see the scrap value because they have not mentioned it explicitly. So we are going to assume that there is no scrap for this project. Now, anything you assume, you have to mention. Okay? Remember, we said those are the marks that you're going to get for skepticism and the like. So you need to mention why you have chosen to take scrap as 0, because the question has not explicitly mentioned whether the project will be sold at the end of the 4 years. Okay, whether the project will stop. Besides, we know that they are actually not going to do so, because when we are starting here, they are going to start with mathematics degree courses, but then they plan to continue, which means that the idea is they are planning to go beyond those 4 years. Okay, so that's why probably they are not selling the project, so scrap is 0. So then from here we now can get the total cash flows. So total cash flows, starting from our taxable profits all the way. So we get our total cash flows. Now, from there, we need to know the discount factor. Now, the discount factor is, because what we have done here, for the most part, is what you also do when you are doing an FM paper, really. It's not so much different, okay? But where things can start becoming different is that in the FM paper, they will tell you that the cost of capital is 12% or 10%. In AFM, they rarely tell you. So that means that they expect you to do some work trying to find that cost of capital. And they told us here that there is a company which is called Bodfari. It produces mathematics and business studies materials for university and professional exam courses. So it's doing similar to what we are doing. It has the gearing of 2575, and it has an equity beta of 1.6. And the debt beta of we are using is 40/60. Then we have risk-free rate. Then we have been given also debt equity. So now, in the exam, there are AFM formula sheets. Let me see if I can find them. Okay. So you need to understand what is on these formula sheets, because they are there for you to actually use in the exam. Now, as you go through the questions, you start to realize which one you are going to need. But for now, I can maybe explain to you based on what we have. We need to, because they have given us, if I go back to what they have given us, they have given us equity beta of this company, Bodfari, and therefore we need to get the asset beta. Now, there is a term which you probably may have heard, but let me just write it here. When there is what we call gearing, or actually they say the gearing, and then regearing. Okay, usually what happens is the cost of capital that you calculate for a given company cannot be comparable for different companies, except if two things are true. One, those two companies operate on the same business risk, which means that probably they are in the same industry and they have similar circumstances of operation, and that's what makes them have the same business risk. And then also those companies have to have the same gearing, the same kind of debt to equity. Now, if those two things are not true, you can't use two companies' cost of equity because they will be different. Now, how do you solve for that? If you can get a company which has a similar business risk as my company, which in this case is this company, Bodfari, and why is it having a similar business risk? Because it produces the same things that I'm producing for university. Okay? So, because of that, we can assume that this company has a similar business risk. And we normally call this company a proxy company. Now, when you get that company, the problem is it might have different gearing compared to what we have. So that's the second point, is that we have to de-gear. We have to de-gear that cost of capital for that company and then re-gear it. Now, the re-gearing and the gearing thing happens with what we call the asset beta on equity beta. Because the equity beta is, first of all, the beta I'm referring to is this beta here on the capital asset pricing model. This beta right here. So this beta on the capital asset pricing model is a number that represents how risky a company's stock is compared to the market. Now, when it is equity beta, it means that that also includes the gearing component of the company. When it is asset beta, it only represents the business risk of the company. So when they have given us equity beta, it means they have given us a beta which also has the gearing part and the business part. So the gearing that we do is to remove the gearing part, okay? The part that is actually caused because of how the debt equity structure of that company is. We remove that, then we shall have a beta which represents what actually our company should be having. So that's the gearing part. Then we after we gear with our own debt structure. So I can say this for 100 days and it may not make sense, but let us calculate, then you start seeing what I mean. So I'm going to bring the two formulas that we need into our spreadsheet. So here we are with our formulas. So now, the first thing we need to do is to get this company information, Boudafari. So Boudafari has debt to equity 2575. So value of equity, value of debt. I'm using these figures, these abbreviations so that you can understand where I'm going to put the formula. And so we have equity beta, which is BE. Okay. And that's what we have. So the value of equity because debt is 25, equity is 75. So I can actually write here 75, 25. Now what I'm doing here is using proportions, but that's okay because we are using ratios. So even if I have the real values, it's going to still give me 75, 25. I'm hoping that you guys are mathematicians, understand that. Then this is 1.6, and I'm going to, so that is the equity beta. So what we need to do is to get the asset beta. Now, how do you get asset beta? We use this formula, which is called the asset beta formula. And they told us to assume that the beta of debt is 0. Okay? So when you do that assumption, this formula becomes smaller because this second part is going to all go away because you can't multiply anything by 0 and remain with it. So it will remain with only this part. So it will be value of equity divided by value of equity plus value of debt multiplied by 1 minus the tax. Okay, and the tax is 20%. You normally have to check if the tax rate is the same, and they haven't told us, so we are going to write another assumption. The tax rate for Tonpantau is the same as the one that this company, Bodafari, also pays. So 20%. Okay, then multiply by the equity beta. So that gives us the asset beta, which is 1.26. So that is the asset beta. Now, after that, we can now get the equity beta. For now, this company of ours, Tonpantau, has a very, very difficult name to say, but I'll just copy it here. So this company of ours, now we need to now get the equity beta. So this formula is going to be flipped so that we get value, we get BE. But that means that we need to know value of equity, value of debt. We can put the tax here, then beta asset, so that we can get BE. Now, beta asset is exactly what we have just found up. Okay, 1.26. Tax is 20%. Now, what we need is value of equity and value of debt. So they told us that the debt to equity ratio of Tonpantau is 40-60, which means debt is 40 and equity is 60. So we can now get equity beta. It's going to be value of equity plus value of debt multiplied by 1 minus tax divided by value of equity multiplied by asset beta, which gives us 1.94. Okay, so that is 1.94 as the equity beta. Now from here, we also have information told to us that the risk-free rate is 4.25. 4.25%. Then risk premium is 5.5. So now we can get our cost of equity. Okay. Now the cost of equity, we can use the capital asset pricing model. is given as the risk-free rate plus the beta multiplied by the risk premium. Okay. Now, the risk premium is always the difference between the market return and the risk-free rate. Now, sometimes they can give you these two figures, but most cases they will give you the risk premium. So you have to basically know what is given to us. Here we have the risk premium. So when you do the math, you get cost of equity as 14.9%. Now, we know that we need cost of capital. Now, cost of capital is not just cost of equity, but rather cost of equity and cost of debt. And here is the formula for getting the cost of capital, which is the weighted average cost of capital. And so I will take the formula that says that you know what we need to find. So this is the formula that we have. So now we need to get the work. Now to get the work, we need value of equity, we need value of debt, we need KE, we need KD. Okay? Now we need KD1 minus T, or we need KD. And we are going to see how that's going to work. Now value of equity, we already know it, and value of debt. So we know those ones. We know this one. But what we don't know is the cost of debt. Okay. Now to get cost of debt. So we know that the debt consists of a 6% bond with a nominal value of 100 and premium of 4% on redemption in 4 years' time. The coupon on the bond is payable on annual basis, and the annual spot rate is given to us. Which means that what we are going to do is to get the cash flows for the 4 years, which is interest and redemption. Then you get the cost of debt. So now how do you get cost of debt? In this case, you normally do what we call the internal rate of return. Okay, so internal rate of return. So we need to first of all know how much is our value. So the bond. So we're going to need to set up here a working. So this working is going to be, ideally, in normal circumstances, you would say year 1 to 4, then you give one interest. But it seems like the rate is changing for each year. So we are going to have to do it for each year. So year 1, 2, 3, 4. Now, the cash flow is going to be, now, this is for $100 nominal. So we are not going to put, we are going to just do for, like, assume that we have $100 nominal. So if the interest is 6%, it means that we have is 6 for each $100, 6. Now on the 4th year, it's going to be 6, but also the 100 plus a premium of 4%. Okay, so I can show you that's going to be 100. Okay, multiplied by 1.04 to get the premium, but plus also the 6, which gives us 110. So those are the cash flows for the 4 years. Then to get a discount factor, so normally the discount factor, if you had one rate, you could even come to the tables and get it from here. Okay? But since we don't have one rate, we are going to use the formula, which I always also advise that you use. It is just 1 plus rate power minus n. So we are going to start with the first year, 1 plus 4.33. So 1.0433 power minus 1. Okay, so that is going to be the n. That is okay. And I'm just going to first drag it and then we make edits. So the second one is 5.15. So that is 5.15. The next one is 5.93. And the next one is 6.58. Okay, so that gives me my discount factors. Then I can put present value as the product of the cash flow and the discount factor. Then you drag through. And then from here, you can get actually the value of debt. So the value of debt is 100.5. Okay. Now, so are we following so far?
Yeah.
Okay. So after getting the market value of debt, then I can be able to find the cost of debt. Okay. So what we are going to do to get the cost of debt is determine the internal rate of return. Now, there is a way that we can do this very fast. What I'm going to do is to just set up the years. 1, I start from 0, 1, 2, 3, 4. Then the cash flow. So the cash flow for year 0 is the market value, okay, of the debt. Then from year 1 to year 4, this is going to be 6, 6, 6, and 1, 1, 10. Okay, like we saw up. Then from here, actually, I can get internal rate of return using a formula, which is something that they advise you to do in the exam. You just do IRR and you give it the what? The values from year 0 to year 4. And you get yourself the answer. Okay? 6.5. But this one only works if you can arrange your cash flows in order like 0, 1, 2, 3, 4. Okay, they have to be contiguous. There shouldn't be any spaces between. If you didn't have that, then you would have to do internal rate of return using the IRR formula, which is like this. Okay, this formula here. So this formula here, what it requires you to do is to make two guesses, okay? A lower rate and a higher rate. Then calculate NPV for those two guesses, then use the formula, okay? If you want to see how that formula works, you see the several examples the several questions that we have done, but also I believe that if you go to the solution to this, you'd find that they probably have used this, okay? Because the examiner, although they want you to use this formula, it is not very easy to demonstrate on a like in a solution that they are trying to make you use for learning. So they usually do the long way. But if you can arrange your years like this, you can do it in a very fast way and you get yourself the cost of debt. And once you have the cost of debt, now this cost of debt is that you get is the cost of debt which is not doesn't have tax, okay? And basically it is better to do the after-tax cost of debt because I don't know if this is going to confuse you, but when you are using this formula here, it works if you assume that your cash flows are your cash flows are perpetuities, like they go on forever, or annuities. But in fact, if you are going to do it the right way, this should not be 6, but rather should be the after tax. So it will be 6 multiplied by 1 minus 20%. So it will be after tax costs. Okay. Then also here you get the idea, but that's not going to affect so much. So let us just do 6, no problem. So once you do that, it means that then you need to have here the tax, then you can get work. So we have got our cost of debt as the internal rate of return, so 6.5%. So we can actually put here KD. Then tax is 20%. Then you now get yourself the cost of debt. And you can see that we are going to use this formula here of work. So it's going to be value of equity over value of equity plus value of debt times KE plus value of debt over value of equity plus value of debt times KD1 minus T. So I can do it like this: value of equity multiplied by KE plus value of debt multiplied by KD multiplied by 1 minus the T. Okay? Then everything divided by value of equity plus value of debt. And if I've done it right, it should give me my cost of debt or work, which is giving me 11.01. Now, usually people tend to just round it off to 11 for 2 reasons. One, you can easily go to the tables and you look for 11% and pick discount factors. Okay? Which is what I don't advise you to do, but I mean, you can do it. Or you can come here and now that you know that it is 11%, come and say is equal to 1 plus 11%. Now you can write 11% there, or you can reference it. And if you reference it, Okay? If you reference it, you have to make sure that it's anchored. This is something that you should be able to do. Per minus n. So that gives you discount factors. And you can see here 0.901, 0.812, 0.731, 0.659, okay? They are slightly off because I've not rounded off this to 11%. I've just used the real figure. Had I used the 11%, they would be spot on. Then from here, I can get present value as the product of the cash flow and the discount factor. Then you can get net present value as the sum of our cash flows. You get the idea. And NPV here becomes negative. So don't accept the project. Ideally, that's what you should be doing. Don't accept the project. But we are looking at this question to explain something that is important. But I hope you have understood at least up to that part. Are we clear on that?
Yes. Yes,
Yes.
we are.
Yes. Now, there is another way of doing this. After doing everything to find the cost of capital, you can just get net present value using a formula. In a formula that you are going to use here, it gives you indications of what to do. Whereas if you are actually doing it in the exam, there are no tooltips. So you need to know how the formula works. And how does this particular one work? It wants you to give it a rate, which in this case, I'm going to give it 11%. If you don't want to decide to give it 11%, you can just type 11%. Then you give it the cash flows from year one. Okay? So cash flows from year one. From year one up to year 4. Then you close it and you subtract the initial investment of year 0. Now, usually, because it's positive, because it's negative, that's why I'm saying I'm putting plus, but ideally you're supposed to subtract it if it was a positive figure, right? And you see I get the same exact answer. By doing so, I have survived the 3 steps and put them in one and got the same exact marks and saved a few minutes to do other things. So, but for you to get to a level where you can trust yourself to use the formula, you need to have practiced it. And just like the one I showed you here for IRR, it requires you that the years that you are dealing with are contiguous. So 0, 1, 2, 3, 4, like you don't have 1, 2, 7, 6, something like that, okay? They have to be contiguous. But this is what you're going to end up with. And you say you have an NPV of minus 2.3 million, therefore should not accept the project. Now, that is part A. Now you may think, okay, it's a lot of work for 12 marks, but the reason why it has been like this is that everything that you're going to write down here depends on what you have calculated there. So if you calculate a wrong thing, you're going to write wrong things here, but that should not worry you. You're going to get the right marks for the wrong things if you explain them right. Okay? Like, for example, if you got a positive NPV, you can lose some marks on the computation somewhere, but whatever comes next when you're explaining, if you explain that figure very well, you are still in the money. Now, what they want us to actually here to discuss real options. So what are real options? Now, when you are looking at real options, and they have told us to look at the Black-Scholes model. Now, the Black-Scholes model here we are not going to calculate it, whereas chances are if it comes in the exam, you're going to have to calculate it. Now, we have a formula here for the Black-Scholes option pricing model, but we no longer use it. Okay, we no longer use it because in the exam now on the spreadsheet, there is a spreadsheet for calculating this Black-Scholes model when you were supposed to do so. So if a question comes and you need to calculate it, they will give you a spreadsheet where you just put in figures and calculate it. There are other questions I have attempted that you can look through and you see what I'm referring to, but also we shall probably get one and do. But here, what we are trying to answer is this question saying, discuss how real options build on traditional net present value analysis. Okay, and they're saying we should do that, and also explain the issues with how to incorporate them. And we need to reference the Black-Scholes model. So now a real option gives you the right, but not an obligation. And this one is either to sell or buy, or you can say to invest or divest in a project based on outcomes. Okay, now I'm going to give you here scanty information, trying to explain to you what this is, and then we are going to go and look at the solution in detail to see how all those waves have been connected together to explain the real option and the Black-Scholes options pricing model. And then if you still are not okay with that, you need to be looking at a couple of like you material that I shared. You have the textbook, which is where I should always run to when something is not yet clear. You go to the textbook and just clarify it so that you are able to explain. As you can see, this paper 50-50 means that you have done your calculations, but also your explanations very well. So a real option will give you that right, but not an obligation to sell or buy in a project based on outcomes. For example, in this case, we are going to use in the case of forget the name. In the case of Tonpantau, you just also in this case copy it and paste it there so that you spell it right. There is an option to invest in other subjects. It's the university and professional courses based on the success of mathematical materials at undergraduate or at university level. So that's an option. Now, the thing is, as you can see, this project is not giving us money. So imagine that we had invested for not just this project, but also the other subjects at even professional courses. So we invested everything all together. That means that we stand to lose more. But because we have only done that first phase, the result of that first phase can dictate whether we should invest more or not. So that is that value, that information, that option is going to be a good option because it means that we don't go all in, but rather we invest what we can afford to use as like a case study in a way to help us. Okay, this time round we tried something, it didn't work out, but okay, we can get out. So that can be one of the ways, but it can also be an option to sell the project. Sell the project. And here also be to sell the project maybe before the end of the project in case we anticipate the project is not viable. Imagine, for example, you start a business and you invest in your money, and you are expecting to get your positive NP. But in case 3 years down the road, you feel like this project, I don't think it's going the way I'm anticipating it to go. I need to jump out. So if you have an option that can help you sell that project around that time so that you can jump out, that is a good thing. But of course, with anything that gives you an option, you need to pay premium for it. So you find that you have to pay a premium for you to be able to use. And this is where this Black-Scholes options pricing model comes in. Here, the terms are not defined. And as I told you, we no longer use this formula. But you can see if I take you to the textbook, it is under chapter 8 options pricing. And this is the Black-Scholes options pricing model. Okay. It gives you this where PA is the current price of underlying asset. In this case, can be the share price, or it can be your business that you're going to sell. How much are you going to sell it at? Risk-free rate, we know it. Time that you have to make that decision, okay, the time before the option expires, because no one is going to buy for you a project from a project which is 5 years on the 5th year. No. Even the people who are buying it are trying to gamble. They are like, if the project is for 6 years and the first 3 years maybe are not getting good profits, perhaps they can buy it and turn it around. So then volatility of the project or the share price in this case, and that is the Black-Scholes option pricing model. But what does it? And here they're telling that in the exam, you need to, the formula is given to you. Okay, so you come here and understand what they are referring to. And so how do you use it? There are two things that we be looking at. There's one we call a put option or a call option. A put option is an option to sell, a call option is an option to buy. So you need to be able to understand which of the two scenarios you are dealing with. Now, like in here, the option that we have is a call option or an option to invest. Because if the project that we are doing is successful, then we can invest more. But if it's not successful, then we don't have to invest. So it is a call option. And so, as I said, in this case, you check and look at some of the questions that we have attempted. but normally they like you to explain what are the assumptions that are there, then you explain how it works. So that's where you're going to bring in the Black-Scholes option pricing model. Now, so me, what I'm going to do now, do you have questions before we proceed?
No, I don't have any.
Okay, so what I'm going to do now is to take you to the solution to this, and then you basically see how they are weaving all that we have talked about, the real options. And because we have to answer how they can help to build your net present value. So there are some projects that you don't accept if it is all or nothing. But if there are options to maybe sell in the middle of the project or maybe invest more, then it becomes attractive because NPV can end up being positive. The problem with those options is that you need to know all of these parameters as I've listed them here. How variable is your project, the variability. You need to know what's the exercise price. What if the person who promised to sell you something doesn't, turns, and all those things. So that's what we are going to try to see. So okay, so now you can see, if you go through, you will see the computations that we have made and how they go about it, how they do internal rate of return here, get the same figure as we got. Then they explain to you how you should arrange it on your work, to arrange it very well on your maybe CBE platform. What I want us to talk about is this part here of the use of the real options. Okay, so they provide additional perspective when there is uncertainty. Like we said, you don't know whether the project is going to be successful. So you'd like to have some kind of assurance. So because for NPV, normally we immediately decide irrevocably, which means that it's all or nothing. If I decide to invest, then it means that I have no choice but to proceed with the project. And if the project is not profitable, I lose my money. So what real options do is that they can help you so that you don't have to make the whole decision now or never. Okay, you can see what I was mentioning. It's not a now or never basis. So you can make the decision, but also change it. Or where you can have additional opportunities that can be exploited once you do the initial one. Like in this case of ours, we have additional opportunities. Like if we make this investment, then we can always move on to the other business ventures for the other subjects and other institutions, which may add value to us. So they calculate the value that you can add by being flexible with the decision, and the value of the option will increase when the uncertainty rate in the underlying asset increases, because it means that if there is a higher risk, then the value becomes higher. Now, the question to be answered and get the marks has to be related to our scenario. So now they are bringing how are they going to help us? Because we have potential to expand investment or abandon it. Okay, that's how it is important. So if we invest now, then we can increase the value of the investment. So this is a call option because it's the option to expand, like I said. Once this project is successful, we can expand. So the initial investment is the premium required to expand. and exercise price is the value of the additional investment. So now they are trying to explain how the Black-Scholes option pricing model comes in by giving you some of these parameters. Okay, PA, PE. Okay, so because it is phased over 2 years, then we can actually withdraw from the project if the initial sales are disappointing. And if that's the case, that means that it is, in that case, will be a put option, because it means that we shall basically sell our investment. So there are two options here. Since we are investing in phases, we can actually don't finish the 4 years and stop like at the end of year 1 or 2. Or we can wait and see if the project is profitable and continue investing more. Now, what are the issues that are going to cause us with this? Is the uncertainties. Okay. If you
Sorry,
talk
just a
about,
small question.
yes,
They are saying the project is over a phase of 2 years. I thought it was 4.
let me take you to our spreadsheet and you see what they mean, the 2 years. They are meaning the investment. You see, we invest right
Okay.
away 20 million
Yeah, yeah,
and
yeah.
another 20 million and another 12 million over these 2 years.
Okay,
Okay.
okay.
Yeah, that they are referring to the investment. The whole project is for 4 years, but the investment phase is over these 2 years. Okay.
All right, yes. Thank you.
Yeah. Mm. So one of the issues that we have is uncertainties, because we don't know what those cash flows are going to be. So now it means that we need to kind of put some possibilities of what may happen, what cash flows do we expect to come, and you can't really predict that much. So it means that the managers may not have the flexibility to adjust their expenditure based on those eventualities. So when they say that we are going to invest, then they may actually find issues to actually be able. For example, if they commission these materials, they may not be able to run out of the project until the 4 years elapse. Okay, so that's one of the problems that that you can get. Then here they try to explain the Black-Scholes option pricing model, where they tell you the assumptions that are needed. So that's what I was showing you here, is that if you, for anything that we use, any formula that is on the formula sheet, you need to know the assumptions and limitations that are in that formula. Because usually when you calculate, you may be asked to give assumptions that have been made. So here, that's what they're saying. It assumes that there's sufficient data available for the volatility of returns. Then also assumes that there's a constant risk-free rate of interest, constant volatility, and a perfect market. Then it assumes that the cash flows follow log normal distribution. Because of the way the formula is, it's like it's a normal distribution. And it was designed for valuing financial options instead of options in physical investments like training material. So it means that by using this Black-Scholes model, these are going to be inherent problems in whatever we get as the solution. Also, it assumes a European style option. There's a difference between European style and American style. European style option means that you can only exercise it on the date when the option expires. Okay? Whereas American style can be exercised on any date before and on that same expiry date. So, because here we can jump out after the 2 years or anywhere between those 4 years, that means that the option that we are looking at is really more of an American style one, which means that if we use Black-Scholes option pricing model, we shall be not very realistic in what we get as our assumption and also the result that we get for that option. So this is basically what they are trying to do, weaving together whatever we have mentioned. Usually, you don't aim for writing this much, okay? Because remember, you're supposed to be guided by the marks that are awarded, and you can see that they are awarding here 8 marks for that. So basically, you need to talk about the real option. Then you talk about the two options that you may have, the call option and the put option, expand to and withdraw then the problems with those real options, 2 to 3 marks. So you don't write a lot of information, but everything that we have mentioned has to be showing up somewhere. So the trick is to not write a lot, but write that which makes sense. Okay, I don't know if that's clear.
Yes,
So
it is.
yeah,
Given the
so
time, even you
yeah,
can't write all that.
yes. So it becomes clearer, of course, with more questions that you practice. And I hope you have already started looking at the materials very fast because, of course, you need to be looking at, you have to pace yourself so that you can go through it and also have enough time to do the questions yourself. Now, like we have done this question, it becomes very important if you are to sit down and do it yourself and see how far you can go with all of these items. That can help you know which areas you need to strengthen on the topic. Okay, so that's it for this question, and that's it for the lesson. I don't know if you have any questions for me.
No, I think not now, but I'm going to try. I'll be trying some numbers, and maybe in case
Yes,
I'll be doing them.
yes. So you can try out some numbers, and then you have questions, you can send them to me. And I see I usually I'm a little bit busy, but I can spare some minutes and get a response to you.
All right, thank you.
Yeah. Thank you so much. See you next week.
All right.